Hi, everybody. My name is Paul Gamble. I'm the CEO and one of the co-founders of Nori. We're a carbon removal marketplace. We've been around since 2017, and we are headquartered in Seattle. And this talk is going to be about how carbon offsets actually work and how they're created, because I think that there are actually quite a few misunderstandings out there about kind of the way that the industry has worked and how it should work going forward. So I want to bring us back to kind of first principles question, which is asking, how do we actually solve climate change? Well, the problem itself is that there is too much carbon in the air. There are too many greenhouse gases, and they've been emitted because of burning fossil fuels. We all know this. But I would suggest that the metric that people often look to is the 1.5 degree or 2 degree temperature targets that the UN is setting. And I think a more useful metric would be measuring the amount of atmospheric carbon concentration. And today that's at about 421 parts per million. When I was born, it was 360. And what we should be trying to do is getting back to 300. 300 ppm was about the level that it was at prior to the start of the Industrial Revolution. So in order to get back to 300 ppm, we have to emit less, decarbonize, and remove the rest. Because even if we were able to magically wave a wand and turn off all sources of carbon emissions tomorrow, there is still far too much carbon in the air. We have to remove it. Now, people have approached this problem in the past with offsets, but I just want to kind of distinguish the different types of offsets that are out there. So there are projects that reduce emissions. There are projects that avoid emissions. And what's unique about these is they are only dealing with future emissions. So they're saying, as a result, is it falling out? Is it flickering? Yeah, okay. As a result of, still going. As a result of doing these projects, there is less carbon going up in the air than would have happened otherwise. And then there are removals, which are projects that actively pull CO2 out of the air and sequester it in the earth somehow. Is it still going? Okay, all right, hope that works. Historically, the vast majority of carbon offsets have been reductions and avoidances. Very, very few of those have actually been carbon removals. So in order to actually solve climate change, we have to massively scale up the carbon removal industry in order to get back to 300 parts per million. Fortunately, there are a lot of different ways that we can pull carbon out of the air. There tend to be nature-based solutions, things like planting trees, growing kelp, soil carbon sequestration. And then there are more industrialized applications like direct air capture and carbon negative cement. And the trade-off is the nature-based solutions are much more scalable and much more affordable today, but they're much more difficult to measure. And the industrialized applications are a lot easier to measure, but they are not ready to scale because they're still extremely expensive. The other good news is there is broad commitment out there from Fortune 500 companies and so on to move beyond reductions and avoidances and moving specifically into carbon removals. And if there's anything that you take away from this talk today, what I really want to land with you is that this is a supply side problem. This is not a demand side problem. There is far more demand out there than there is supply available. So we need to be approaching this from how do we remove barriers to entry on the supply side of carbon removal. So how do we do that? Well, you pay people. That's the simple way that we always know works. You need to create financial incentives for people to pull carbon out of the air. So I want to detail how this has been done in the past. So there are a number of different private nonprofits that are called carbon offset registries, like Verra, Gold Standard, and Climate Action Reserve. You can think of them like certification bodies, and they maintain databases of serial numbers representing different carbon offsets. And in order to create a carbon offset project, first you have to develop a protocol. That can cost a lot of money. You have to get the project validated, so you partner with environmental scientists who can come in and basically create a model that tells you how much carbon is part of your project. And then you go do the project, and you get it verified by another third party, and they're checking to make sure that you're actually doing it. And then at that point, the registry will issue the carbon credits to the project, and most of the time they'll sell those to a broker. And then that broker will go try to find a buyer, and then that might be another broker, and then they might sell to another broker. And so the carbon credits can resell many times over. And then maybe sometimes, it's probably about less than 25% of the time, carbon credits are retired, which means you pull it out of circulation, you say this is no longer available for resale. When I got into this in 2015 and 16, I wanted to understand how big is this market? Like, how much are people paying for carbon offsets? And this is a screenshot from a report by a group called Forest Trends. And they put together an annual State of the Voluntary Carbon Markets report. And I was looking at this in 2016, and my first thought when I saw this chart was, they broke this up into primary and secondary sales. What the heck is a secondary sale? And it turns out that's from carbon credits reselling. And the other thing you might notice here is that the secondary market is much larger than the primary market. And that's because of the resale. I don't believe that carbon offsets should be traded. If we're going to be serious about dealing with climate change, we should be designing our systems so that every new dollar spent results in net new carbon that's coming out of the air, not pushing pieces of paper around and enriching middlemen. And then lastly, carbon trading is full of fraud. So this is a screenshot from a case in the EU exchange trading system, but also I think the more notable one is the Chicago Climate Exchange, which about 10 years ago collapsed. It was an attempt to build a market for soil carbon trading in the US. And what would happen is you would have related parties doing off-book swaps with each other. So you say, I'll sell you credits at $1, you sell them back to me at $1.25, and we're going to mark to market as if they were actually bought and sold at the prevailing market price of like $14. And then you get analysts and commodities traders looking at that and saying, look at all this trading volume happening. This is a real investable commodity. It was a farce, and it collapsed underneath itself. So what is the result of this? How does this whole system work? Well, you get a system where project developers are paying a lot of money just to certify their projects. That doesn't include the capital expenses or the operating expenses to actually do whatever it is that they're doing. And carbon removal specifically is often more expensive than carbon avoidance, and they can't get past this barrier to entry. And then credits are sold and resold many times over. And if you look at the total amount of money that is spent on the total lifetime of that carbon credit, very little of it, maybe 10% or less, actually ends up in the hands of the original project developer. And going back to what I was saying earlier, like we need to be creating more financial incentives for the supply side. And right now, all we're doing is enriching middlemen. And then I think even worse is the resale opportunity here means that you can have like oil and gas companies buying up a bunch of cheap carbon credits, making some PR announcement about it, and then when no one's looking, they're holding them on their balance sheet, and then they flip them later on. And then do they really get to take credit for it? Like, of course not. And it doesn't actually do anything for the amount of carbon in the air. And there's no transparency on this. We don't actually know what the carbon price is, because all of this happens behind closed doors facilitated by brokers. So that Forest Trends report, it's a self-reported survey, and we're only getting data from the biggest companies in the world because they're publishing environmental reports for their shareholders. We don't have insight into transactions that are happening at small scale or between small businesses and that sort of thing. And the worst part about this is the offset registries have zero incentive to change any of this. One, they're nonprofits, so they don't have the financial incentive to scale up. And two, in a supply-constrained market, they're deriving all of their fees from the supply side. So they charge registration fees, listing fees, transaction fees, and consulting fees. So they're making money off of this. They have no reason to change. So here's what we should do differently. First, carbon removal should be prioritized over carbon avoidance. Market forces are already pushing us in the direction of the emit less part. It's already cheaper to build new renewable energy than it is to maintain existing coal power plants. Second, carbon credits should never be sold more than once. They should be retired immediately upon sale. And the sale should happen in an open, transparent way where we can see everything like who did the removal, when and where it happened, who measured it, and how it was verified, and what the price was paid and at what volume. And then lastly, we still want a tradable commodity asset for price discovery. It's important that we build a global commodities market for carbon, but it should not be the carbon credit itself that is traded. We need to have a secondary asset to represent that for price discovery. So that's what we do at Nori. We are a marketplace that connects suppliers of carbon removal with buyers who want to be carbon negative. We partner with third parties who do the carbon quantification to dramatically reduce that cost. And then third parties come in and do verification to ensure that the carbon removal actually happened and continues to stay out of the air. The product that we sell is called a Nori removal ton, or NRT. One NRT is 1 ton of CO2 that's been sequestered for at least 10 years. It's warranted to the buyer for 10 years, and this is interesting because if you're like a big enterprise company and you're buying carbon offsets, you often actually see this as a liability. Because let's say you buy a bunch of forestry credits, and then that forest burns down or gets harvested, you are going to get destroyed in the press. This has happened many times. And so what they do is they put an enormous amount of effort into diligence by hiring a ton of consultants and finding these brokers who can source high quality projects for them. And all this is doing is driving up transaction costs and again, making it more difficult for new market entrants to come into this space. So our solution is to offer a full 10-year warranty. If we discover that carbon has been lost, we will buy new NRTs on your behalf. And all of these have been verified via our peer-reviewed soil carbon methodology. And when the NRTs are sold, they're immediately retired. We actually record these as NFTs, and once they get transferred to the buyer, they're made non-transferable. It's there forever. Now, we are agnostic to the different ways of carbon removal. I want market forces to figure out what is the most efficient and effective way to pull carbon out of the air, but we had to start somewhere, and we focused on regenerative agriculture because of the enormous potential for scaling. All told, around the world, you could remove about 5 billion tons every single year, which is 10% of our global annual carbon emissions. And the way this works is farmers will do things like reduce the amount of tilling. This is called no-till. They plant cover crops, so they're keeping roots in the ground year-round, and they're implementing more complex crop rotations. And in the soil itself, what's happening is they're doing these practices that increase the amount of organic matter that's growing in the soil. And the organic matter is the carbon. And when they adopt these practices over time, not immediately, but over time, they will increase their crop yields and they will become more resistant to drought and flood. So it's to their benefit to do this, but they need bridge financing to help get them over the hump, and that's the role that paying for carbon storage plays. So this is Trey Hill. He was the first farmer that we worked with. He's in Maryland. He runs a 7,000-acre soy, corn, wheat farm. And he sold about 14,000 tons. He made about $210,000. And he only paid $4,000 for verification, which is about a 90% reduction in cost relative to what he would have had to pay by going through the existing offset registries. Now, I mentioned earlier that we need a secondary trading asset for price discovery, and that's the role that our Nori token plays. So we've been around for almost 5 years now, and we took the approach of let's build the carbon side of the business first, prove the concept that we have the ability to measure and verify the carbon, and then let's finally launch our token for price discovery. And the way this works is one Nori will always be able to purchase 1 ton. The price of Nori will float relative to supply and demand. So in the same way that like if you want to know the price of oil today, you look at Brent crude or West Texas Intermediate, there are reference prices. We want the Nori token to be a reference price for a ton of CO2. So in fact, oftentimes we're compared to other carbon credit companies, and we do that, but this is the purpose. The main goal of Nori is to create a price discovery mechanism for carbon. You can learn more about that at nori.com/token. We're going to be launching this finally in a few months, and I'm really excited about that. Since we launched in 2019, we've accounted for about 76,000 tons of CO2 that have been removed. Buyers have paid a little over $1.4 million to farmers, and we have several thousand customers. And you can think about what we're trying to do long term as being like Stripe, but for carbon removal. So an API that can be integrated into any sort of platform or protocol where carbon removal just becomes invisible and automatic in the background of everyday life. We've lately been partnering with a lot of NFT artists, in entertainment industry, NFT marketplaces. About 25% of our sales are going through crypto and Web3 platforms. And we're seeing more, like there are some play-to-earn games that are putting a portion of their profits towards buying carbon removal. That's how we scale this up. I don't think it's driven by Fortune 500 companies. I think this is much more of like a grassroots, like new economy type of solution. So that's it for my slides. You can find these at go.nori.com/how-offsets-work. You can go to nori.com yourself, and if you want, you can pay for removing the emissions of the flight that you took to get here to Austin. And you can find me on Twitter at Paul Gamble. Thank you. Yeah.
You said that you give the NFT to
the buyer, yeah.
To the buyer, and it's not transferable anymore.
Correct.
How do you deal with buyers that don't have an NFT, an Ethereum account or a crypto account?
We'll just make one.
And you hold the keys for them?
Yeah.
Okay.
It's actually not really a big deal. Most of the buyers don't even care about that. What they want to see is a dashboard that can display like the certificate of what they want. And so on the certificate, you can go and see like literally the map of the field where the removal took place. You can read the verification report, learn about the farm. That's what's far more useful for our customers because they need to be able to show that to their own consumers.
Okay. Yeah. So there's no demand for holding these proofs.
So, some people do that, but if they do that, then they're capable of creating their own wallets.
I have more questions, but I don't know if I should.
Yeah.
I was wondering if you could talk a little bit more about additionality as it relates to ag removals.
Sure. Yeah, so in carbon offsetting, there's this concept of additionality. And there are actually two different additionality tests that are applied in the legacy system. So the first is the question of incremental carbon removal, which is relative to a baseline, is carbon being avoided or removed? And so the way that we do that is when we're collecting operating data from farmers, we're looking at what year did they make the practice change switch from heavy tillage to no tillage, or they started planting cover crops, and then that sets the baseline, so we're measuring relative to that. And then also in the legacy system, there is the concept of financial additionality, which is to say, would this carbon offset project have happened if not for the revenue derived from selling the credits? I think that's ridiculous, because that means that only unprofitable projects could ever qualify for carbon credits. And we need to scale this up. So we fundamentally reject the financial additionality test. We don't do that in our market. We think that if people are performing the service of removing carbon from the air, then they should get paid for it. Yeah?
So what do you think of Klima DAO?
Okay, so Klima DAO is really exciting because it shows that there's like enormous interest from people in the crypto community to want to use these tools to help solve climate change. However, I think what Klima is doing is causing net harm. Because ultimately, we have watched the price action and seen that it is not working, it has failed. But ultimately what they're doing is they're purchasing carbon credits coming from these registries that no one ever wanted to buy in the first place. And what it's doing is perpetuating this system. I think that the way these registries are set up is bad. It does not work, and it's preventing us from scaling. And Klima is just perpetuating that problem. So I don't really like the way that it worked, but I do really like the motivations and seeing that there's so much energy behind wanting to use blockchain and crypto to solve climate change.
So you're becoming your own registry?
Effectively, yeah.
How do you adapt to time sense?
Yeah, I think so. In the future, we would like to go in that direction. I think there are some incentive alignment problems that we haven't figured out how to solve yet around, like, it's possible to create incentives where people just want to approve all sorts of different methodologies that might not actually have that level of impact. And so we don't want to rush headlong into just like forming a DAO that gets to choose when methodologies are approved. For the soil carbon stuff, we partner with a company called Soil Metrics that does quantification. And Soil Metrics is a spin out from Colorado State University, and they use a protocol that was developed by the US Department of Agriculture. So this is the federal government's greenhouse gas accounting platform, and that's kind of the best that we can do right now. No, we're not. Yeah, so we really want to add more, and we've wanted to do that for a long time, but we keep running into different challenges that are kind of out of our control. One is that the more industrialized applications are we're finding that companies like Microsoft and Stripe have basically bought up all the supply over the next 5 to 10 years, and so they're unavailable to create like an actually global open market for that. And then on the nature-based side, like we're really interested in kelp farming and other blue carbon stuff like mangrove restoration and so on. But we've talked to everyone in the space, and no one has, to your question, no one has good enough validated science backing the claims of how measurement and verification would happen, and we don't feel comfortable accounting for that yet. So there needs to be more development in the industry before we can onboard new methodologies.
Blockchain, et cetera, fits into kind of a scope 3 SBTI situation, especially, 2030, 2050?
Actually, here, let me share a controversial opinion. I don't think scope 3 is an effective way of accounting for this stuff because everybody's scope 3 emissions are somebody else's scope 1 emissions. And that's my short answer. The longer answer is I'm not really concerned about this stuff because everything is already moving that direction. Like we're going to be deploying, when we finally launch our native token, we're going to be deploying on Polygon, minimal impact. Because of the adoption of renewables and everything that people have been talking about already today, like everything's going in that direction where I just don't think it's going to be that big of a deal long term. Now I do think that on like the carbon side and on the blockchain side, we especially need massive deployment of new nuclear energy. Because I was talking about like direct air capture as an example to remove carbon, and nature-based solutions will not get us all the way. We're gonna have to build more industrial stuff. The amount of energy you would need to power that much direct air capture is anywhere from 2 to 10 times the amount of energy that the world produces today already. So that the only possible way that can happen is with massive nuclear deployment.